So we have the question there. This is 2021 paper. So we are starting with the first question, as you can see. So we have the information in the trial balance, and also we've got some adjustments down which we are going to read through thoroughly when we start the calculations. Yes, so first of all we're going to start with the headings. So since the name of the company, this is Morfoot company, so we have Morfoot company statement of profit and loss account for the year ended 30th June 2018. So now I don't have a good ruler, so I'm going to use my hands as our ruler. Okay, so as you can see in the question, we have the question itself is inspected with 3 zeros on top, so which means we're going to put the zeros on top so that we don't write big numbers. The first step, and then since this is the income statement, we are very familiar with it, with the format, so we are going to start direct into the question. So the first thing that is going to appear is our revenue, and in the question the revenue is revenue, which is sales. Revenue is 13,600. so we have to look if there is sales returns or returns inwards in the question. So in this sort of situation, we don't have sales returns. Okay, we don't have sales returns. Yes, so the revenue is going to go direct in the last column, 13,600. Next, we are going to the cost of goods sold. You underline. First thing to appear under the cost of goods sold is our stock, which is the opening stock in this case. So the opening stock, according to the question, even to on 1st July 2017 was 1530, 1530 kwacha. We've indicated it. Next we come to purchases. The figure of purchases which come in the mid column is the net purchases after the adjustment. The adjustment on purchases comes in when we have returns outwards and also carriage inwards. So for returns outwards we subtract, then for carriage inwards we add. If you have any of the two, you do it following the same way. If it is inwards only, you add it. If it is returns outwards, you subtract it. If you have both, you add this one and subtract the other one, just like that. Then the final answer that we're going to get now, that's the one we're going to take in the middle column. So looking into our question, I think we don't have any returns outwards. Yes, we don't have any returns outwards. Yes, so since we don't have any returns outwards, this same purchase figure is the one. You don't have enough carriage inwards. This same purchase figure is the one that we're going to take in the middle column. So our purchases, it is 8,100. So since that's all that we need here, we're going to add the two. So we have 1530 plus 8100. We have 9,630. Then less closing stock. So our closing stock, remember, it is not found in the trial balance. We have to put with adjustment. So even to 30 June 2018 was valued at 1,660. Of course, it is 1,660,000, but then since we've written 3 zeros on top, we're just going to get the 1,660. So 1,660, we're going to subtract it. So we already have the 9,630 on the calculator. When you subtract the 1,660, we're going to remain with 7,970, which is the figure we're going to take in the last column. This is our cost of sales figure. Then when you subtract it from our revenue was 13,000. 13,600. We have a 5630 figure here. Then the next step we have to check if there is a decrease in the allowance for receivables or provision for doubtful debts. So in our case, the provision for doubtful debts, allowance for receivables, if you check through the question, it is 18. This one here, it is 18. And in the statement, in the first and second adjustment, they are saying trade receivables balances totaling 600 to be written off. That is bad debt. And the specific allowance for receivables increases to $30,000. So now, since it is increasing, because it is increasing, that increment itself is going to be an expense. It was at 18, this time around it is at 30. So that, because it has increased, that increase is going to be an expense. If it had to decrease, that increase was supposed to be a gain, which was supposed to be added to the gross profit. Remember, the figure to have here is a gross profit. So since it is decreasing, it's going to be an expense. So we're going to check through the question if we have any incomes through gain, that is anything that has received at the end, not receivable but received at the end. So in our case, I think we don't have. Yes, we don't have. So we're going to less our expenses. So less expenses, put a heading. So we're going to start with the first foremost. In the first foremost, we're going to start with the expenses that are on top. So in this case, we have distribution cost. Let me say, yeah. So we have distribution cost, and remember, distribution cost, I've got an adjustment down, so we have to take account of that. So distribution cost, the figure is 1460. Then since we have adjustments, we have a prepayment and accrual. So as usual, we know that prepayments are subtracted, accruals are added. We're going to do that. So since there's distribution cost prepaid, which is a 60, since it's a prepayment, we're going to subtract, and then there's distribution cost accrued, which is a 120. We're going to show it that way. So we have a 1460 minus 60 plus 120 which is giving us 1520 as the distribution figure that we're going to bring here, 1520. Okay, then next we're going to go to what's the next expense. Following the question, we have administrative expense, which is having also an adjustment. So we go to administrative expenses. So administrative expenses as well are having adjustment. So the figure for administrative expenses is 1590. Going into the down to the question, there's an accrual and a prepayment. So as usual, we know that prepayment we have to subtract and accrual we have to add. So administrative expense prepaid, which is a 70, will subtract. To mean the subtraction, we're just going to indicate brackets. Then for the accrual, if you check through the question, on administrative expense we have a prepayment of 70 and an accrual of 190. So the 190 as well will come down here because we are adding it, because accruals are added. We're going to leave it outside like that as well. So we have a 1590 minus 70 plus 190, which is giving us a 1710. Okay, then we go back to the question. So we're administrative expense going down, there's interest on the loan, we'll come back to that. Then on interest on the loan, you are going to be given a percentage. They'll say 10% or whatever percent that will be given, and the figure will be indicated. So if you find that figure on the debit side, that means the interest on that loan, the figure that is found on the debit side is how much they have paid. So we'll come back to that later. So there is dividends declared and paid. That one is done at the end. Then we have these other figures. First of all, let's not forget there's this part where they said trade receivables are totaling to 6,000 are to be written off. So we have to remove that 6,000 as a bad debt. trade receivables, these are debtors, people that are owing you. So if they say at written off, means you have discovered that these people are not willing to pay, this money will not come back. So no wonder you're moving it as a bad debt. The money is already gone, it will never come back to the business. Maybe the people have passed away, something like that. So we have bad debts figure of 6,000. Remember, I have 3 zeros on top. We're just going to write a 6. Next, yes, since we said we have we have allowance for receivables in the trial balance, which is found on the credit side, and then they're saying the allowance for receivables increased to 30,000. Since it is increasing, that increase, I said it's an expense. So we're going to say 18. Let me say 30 minus 18. 30,000 minus 18,000. So we have a 12,000. So increase in allowance for doubtful debts it is 12,000. So since we have 3 zeros on top, the increase just is what we've indicated there. Next, okay, next we are going to go to our depreciation. So depreciation, the information depreciation is indicated below. They're saying land doesn't depreciate, so no wonder the depreciation is indicating new there. Then for buildings, 2% per year on cost. So 2% is a 2 over 100 times the figure of buildings was figure was 8,300, yes, times 8,300. So the depreciation there is 166. So depreciation deep, so buildings is 166. Then deep, what else we have? Warehouse and equipment. So we'll go back to warehouse and equipment. They're saying the depreciation is 15% per year on cost. So 15% per year on cost, same applies. 15 divided by 100, it's going to give us that figure times the value of warehouse and office equipment. Warehouse and office equipment is 1,800. So that figure times 1,800, which is going to give us a 270. Next, we have a depreciation of motor vehicles. Motor vehicle depreciation. Go back to the question. Depreciation of motor vehicles, it is 25% on cost as well. So 25% times the cost of motor vehicles. So the cost of motor vehicles was 1680, which is giving us the depreciation to be 420. So what else do we have? Just one part that we've not touched, that is we have skipped the 10% loan notes. Otherwise, the rest of the information we don't need it in the income statement. Then following the adjustment here, the first adjustment is our inventory, for which we've dealt with. Second adjustment, we have bad debts, which is supposed to remove, and also increase in allowance for receivables, which I've already touched. Third, we have accruals and prepayment. So we've talked about depreciation, distribution costs, and administrative expenses, in which we've subtracted the prepayments and added the accruals. Then coming down, there's interest on loan note. So that interest is an accrual. So since accruals are current liabilities, we'll take it in the balance sheet at its right time. Then remember, we are preparing this on 30th June 2018. So on the fourth adjustment, there is in early July 2018. July, we are preparing in June, but this is July. In early July 2018, Mufort Co. received invoices for credit purchases totaling to this for goods delivered before 30 June. These invoices have not been included in the accounts payables at 30 June 2018. So, yes, there's that information, but then the fact is we are preparing this in June. And this information is concerning July, which means we don't have this information in here. if we bring this information in here, it's going to affect our accounts, which are not going to balance. So we'll not use it. We'll come back to that later. Then it was also found that credit sales totaling to 7,000 for goods delivered to customers before 30 June had mistakenly been dated in July 2018. So this information is also for July. We don't need this information. This is June. We're preparing this account in June, so we're not going to use this information. So next, we're going to add all the expenses that we have in this case. So the first expense that we have is 1520 plus our 1710 plus 6 plus 12 plus 166 plus 270 plus 420. So we have a 4104. We have 4104. We have a 4104. So that is the total of expenses. We're going to subtract it from the 5630 that we have on top there, which is going to give us 1526 as our net profit before interest and tax. So this is our net profit before interest and tax. Next, we are going to less our interest, less interest. So our interest, following the question, they're saying 10% loan notes interest, 10% loan notes. So the loan itself was 1,000. Of course, we have 3 zeros on top, which is going to make it 1 million. But then we have 3 zeros on top. So